Good afternoon, my people. What is going on, Wealth Our Way family? It is your man, Charles Tank Harris. Today is Monday, May the 24th, 2021, and I'm coming to you live and direct from Salem, Virginia. I don't even know where the hell Salem, Virginia is. It's somewhere near Roanoke, Virginia, though. But you see, I'm representing TU all the way down here in Virginia Tech territory. I don't give a damn. I hope everybody had a great weekend. I want to thank each and every one of you personally who are here with me live, streaming from StreamYard onto both YouTube and the Facebook Wealth Our Way platforms. I also want to give a special salute and shout out to all the Wealth Our Way Nation that catches 15 minutes of finance pre-recorded overnight, over the weekend, or wherever you can squeeze in 15 minutes of financial literacy. You know what? Because I'm not doing any share screening today or anything like that, I don't need these glasses. So I'm gonna take the glasses off because I don't need to read anything. I just need to see my own handsome face in the monitor, and we'll go from here. So last week was the bomb. I hope you guys really appreciate the strength and the leverage of being able to bring other professionals on, other prognosticators, other people who have knowledge in every area of finances as well as personal development to talk to you guys as an audience. I will be doing more of that. I'm on a lot of different platforms now, and as a result of being on these different platforms, I'm running across some professionals who have a lot of knowledge in various spaces, and I will bring them to you guys for you to pose your questions and get your knowledge on. Also, I'm going back over all the comments from last week, and I'm answering the ones that are applicable to me. And I'm also getting the guests to answer the ones that are applicable to them so that you guys get all of the knowledge and answers that you want. And I also would encourage you to keep the questions coming, whether it's through the inbox or just in this forum itself. You guys know how to get a hold of me. And Renee is always on board. You can email Renee at wealthourway.com. So today I decided I'm listening to a book called The Five Common Mistakes That Every Investor Makes. And I will later on put it in the comments because I'm outside the car and the book is on Audible on this phone. So I can't really give it to you right now who the author is. And my stepdaughter, because we're riding back from Atlanta right now, is in the car having school. So I just want you to know my commitment. I'm going to jump out the car and give you 15 minutes on the ride up. I've been up since 4 this morning. Got on the road early to get up back up to Jersey from Atlanta after seeing my baby girl Zoe graduate. Mwah, congratulations, yo. So yeah, I want you guys to understand that one of the things that I heard in this book that goes right along with what we were talking about last week is how confusing being a sound, good, long-term investor can be. I spend a good amount of time on other social media platforms, including Clubhouse. I'm constantly talking or hearing people talk about investments. And one of the things that is just really catching my ear as I'm hearing people speak in these various platforms is that people seem to have a misconception between what is actually long-term investing and what is short-term speculation or trading. And I want to be clear. I'm the type of person who, I like the phrase, if you like it, I love it. Do what makes you happy. But if you come to me and ask me about building long-term wealth, I'm going to tell you I'm the boring investment guy. I'm the guy who's going to tell you to build a portfolio based on your risk tolerance. Your asset allocation will be derived from knowing what your long-term objectives are. And we're going to achieve building you a portfolio of very, very low cost exchange traded funds or mutual funds. And it's not going to be sexy. You're not going to be able to go to a cocktail party and tell your friends about how you caught Tesla before it went up to 1,000. By the way, if I ever mention a stock on here, I just always want to be clear. As a person who has passed the Series 7 license, the Series 6, the Series 63, the Series 65, I want to let you guys know I'm never here giving you individual securities advice. I am never here telling you what, and I'm never here telling you what I suggest. I'm telling you strategies, I'm telling you plans, and I'm giving education. So from that standpoint, we're going to talk today about demystifying the stock market because in this book, The Five Common Mistakes That Every Investor Makes, he talks about some things that I think it's important for my audience to know. So first and foremost, What is a stock? Now, a lot of you guys in Wealth Our Way Nation have had this covered before, but I'm glad to say we have some new eyeballs on the site. So I want to go back to the basics and talk about what a stock is. A stock is a piece of ownership in a company. Normally, when we're talking about investing, we're talking about investing in publicly traded companies, and thus those stocks are available in the stock market. There are very, very many stock markets. But when we're talking about stock markets, we are normally talking about the S&P 500, where S stands for standard and P stands for poor. Standard and Poor's 500. It is the 500 large, well, not the largest, but 500 of the largest companies in America. When you are looking at the ticker symbols going by on CNBC or MSNBC, and they are in the right-hand corner, you see S&P. That is the S&P 500's valuation. So what does it mean to buy a share of stock, and how does that help you grow your net worth and your overall portfolio over time? Stocks are supposed to reflect the value of the underlying company in which it represents. We know, though, if we follow the market for any length of time, that the actual price of a stock does not accurately reflect what the actual company is doing. Why is that the case? Because in a stock market or any type of market, you have a buyer and a seller on opposite sides of a transaction. And when you have a buyer and seller on opposite sides of transactions, the only thing that matters is how much somebody is willing to pay for what it is you are selling. So there are often times where people don't understand why stock prices fall or why stock prices rise. And the rationale for this is somebody is willing to pay a certain price for a particular stock. And if you have that stock to sell, you as the seller will meet up and be matched up with a buyer, and then a sale will take place. If you look at the broad-based S&P 500 and you look at over time, you'll never see a situation, even when the market is going up for the year or going up on a particular day, where every stock on the index has went up. Normally, you'll see maybe the top 10 to 12 stocks going up, and they represent such a big portion of the market that they have the ability to drive the overall market. Why am I telling you this? Because over time, I have seen more and more people lose money because they desire to try to pick an individual stock and see if that individual stock will make them money. And over time, they normally get it wrong. The best way to make money is to buy a broad-based mutual fund that represents an index, or to buy an exchange-traded fund. One of the things I wanted to talk about after listening to this book today is what they talk about active management versus passive management. Active management are mutual funds that have a fund manager whose job it is to outperform whatever stock market they compare themselves to. Because as I said, there are many different stock markets. So you do have the S&P 500, which represents big companies. You have the Russell 1000, which represents small companies. You have the NASDAQ, which represents smaller and technology companies in a lot of instances. And you also have the EFA index, which represents the global economy as a whole. So every mutual fund or exchange traded fund is compared against one of these indexes. And it's the fund manager's job to try to beat the index. What time has shown us is that there are very few managers who can consistently, year in and year out, beat the market. In fact, I think the longest streak anybody had was about a 15-year streak by the guy who ran the Legg Mason Value Fund. And he turned around and lost all the gains that he had made from beating the market for 15 years. He gave them back in 3 years. So it's been proven over time that the best way to build wealth is to get yourself a diversified portfolio of exchange traded funds, which happen to also have the lowest expenses that you're going to pay. They also have the lowest taxes that you're going to pay, and just put money into those funds. You guys who have listened to me talk before know that I am a huge proponent of what is called dollar cost averaging, which is taking money at a set period of time and investing it into your diversified portfolio regardless of if the market is going up or down. One of the interesting things in this book is that the author disagrees with me. They disagree that dollar cost averaging is a good idea. The person who wrote the book says you should put all of your money in the market today because over time, that is the best way to make most of the money. But what they did say, which was very much why I preach dollar cost averaging, they said dollar cost averaging is for people who would otherwise pull their money out of the market when things don't go well. If they see that they have the ability to put money in when it's going down, and also that all of their money wasn't lost when it went down, they're more likely to stay in the market. That is why I believe in dollar cost averaging. Being able to be careful and also not be scared out of the market is the best way to do things. I always tell people about, I contrast investing with my weight loss journey. And like the market, I have recaptured some of what I previously lost. So the reality is that when you have a weight loss plan, you go to a trainer and they tell you, hey, you got to do these exercises or you got to follow this nutrition plan. The only plan that is a good plan is the one you're going to stick to. So it's one thing for me to teach you about the stock market, tell you to go ahead and put your money into the stock market, but the minute it goes down, you want to take all of your money out. That's not a good plan, which is why I focus on dollar cost averaging. So when I say I want to demystify the stock market for you guys, I want to give you some confidence and help you understand what makes the stock market go up and go down. If any of you guys have a mirror, I'll give you a second to grab one and look at it. Yes, the answer is you. Stock markets do not go up and down because the companies are doing well or not doing well. That's why they should go up and down. But they go up and down because of human behavior, because of emotions, because people tend to buy at certain times and sell at certain times. And it is this buying and selling that makes the market go up and down. If we were to take human emotion out of the market, the only thing that should drive the stock market up or down are the earnings of the companies that are in the market, what they earn. When we buy a stock, we are buying a piece of ownership in a company that we believe is going to earn money. We are willing to pay a certain price today for the right to that stream of earnings moving forward. When you look at the stock market or any individual stock in the market, it is measured by a ratio called the PE ratio. And that's not Public Enemy. That's the price to earnings ratio, where price of the stock is divided by the earnings of a share of stock, and you get a ratio. Right now, I believe the S&P is trading around 26 times earnings. That is historically slightly expensive. When you look at the earnings of a stock, when you look at stocks that are 40, 50, 60 times earnings, that's an expensive stock. When you look at a stock that's 5, 7, 10 times earnings, that's more of a cost-effective or what they call a value stock. When you are willing to pay 50 to 60 times earnings, you are expecting a huge return from that company. Those are normally tech companies or pharmaceutical companies, companies that have high growth. When you look at the lower PE stocks, you also think of stocks that pay you a rich dividend and put cash in your pocket. So when you are next time looking at a stock, don't look at what it costs per share. That is the price. Look at the price to earnings ratio and see where it ranks relative to the general market. And then you can determine that stock's value. What you always want to worry about when you are purchasing anything, not just the stock, is the value of that thing, not the price of that thing. I will pay as high a price as necessary for something that I value. I will not pay pennies for something that has no value to me. So make sure you learn to focus on the value of something and not the cost, which is the price. So with that being said, I want to thank you guys. The sky looks rather ominous behind me. I'm about to get back on the road so I can get up to North Jersey. I will see you guys tomorrow at 12:30. And remember, as I always tell you here on Wealth Our Way, wealth is not only for the wealthy. Take care.